Concept number 11, that is fair forward rate. Till now we were talking about what is a forward rate. We have understood what is a forward rate, a rate which is agreed between you and bank for buying or selling currencies at a future date, specified future date, and the rate is agreed today. Now, we were calling this as a forward rate till now. We would definitely call it as a forward rate, but we would now call it actual forward rate. Why actual forward rate? Actual forward rate because this is a rate actually quoted by a bank for entering into a forward exchange contract. We are trying to assess whether that rate is appropriate or not. So, suppose price of dollar today is rupees 65 and you go and you have to buy dollars after 3 months and bank is quoting rupees 75 per dollar. We also understand that dollar might appreciate against Indian rupee, but over 3 months 65 cannot become 75, correct? This much common sense also anyone can have. But friends, merely having that common sense is not enough. You should also know how to determine whether that forward rate is appropriate or not, and that calls for understanding this concept, that is fair forward rate. Through calculation of fair forward rate, you will get a forward rate which should be the prevailing forward rate. That means that is a fair forward rate. That is the rate which should prevail. If the bank is quoting the actual forward rate close to, very close to the fair forward rate, it is okay. But if the bank is quoting a rate with a substantial difference with the fair forward rate, that means actual forward rate AFR and fair forward rate FFR, they are substantially different, we can challenge the bank and we can bargain with the bank, we can negotiate with the bank, and we can bring down the bank to the fair forward rate as close as possible. And here there is a linking concept of arbitrage which we are going to discuss at little later part. So friends, let us do one thing. How to determine this fair forward rate we'll be learning through question number 18. The information given in question 18 reads as spot rate $1 equals to rupees 64, interest rate prevailing in India is 12% and interest rate prevailing in the US is 7%. Determine the fair forward rate for 1 year. So friends, what we have been informed, just 3 things, correct? The spot rate of dollar in terms of rupee, and then interest rate prevailing in India and US. And this information is enough for us to determine the fair forward rate for 1 year. Let us see how to do that, first logically and then by applying formula. So consider the fact that one side we have US, one side we have India. In US, if there is $1 held by someone, in India the equivalent rupee value is rupees 64. So what I am trying to tell you is $1 today and rupees 64 in India, both of these are at par value, correct? Because as per the spot rate, $1 is equal to rupees 64. So now imagine that someone in US is holding $1. This party would obviously invest this $1 in US itself at 7%, whereas someone who is holding rupees 64 in India would invest this money in India at 12%. So what would be the maturity value of these respective investments after 1 year? In US, it will become $1.07 after 1 year. In India, the maturity value of this investment will be rupees 71.68 after 1 year. So what we conclude is, after 1 year, $1.07 should be equal to rupees 71.68. Mind it what I just said, $1.07 should be equal to rupees 71.68. I am not saying it will be equal to, I am saying it should be equal to. So we write up that line, after 1 year, $1.07 should be equal to 71.68 rupees. So if $1.07 should be equal to rupees 71.68, what should be value of $1? Value of $1 should be obviously 71.68 divided by 1.07, and that comes to rupees 66.99. So what we conclude is, therefore, fair forward rate for 1 year will be $1 equals to rupees 66.99. Let us now present the same thing using a formula. That is how you will be solving questions in examination. So FFR equals to S into 1 plus IL upon 1 plus IF. So what is FFR, what is S, what is IL? Let us write up the description of each variable. FFR stands for fair forward rate. S is the spot rate which is given as rupees 64. IL is the interest rate prevailing locally, that is 12%, and IF is the interest rate prevailing in foreign country, that is 7%. So when we substitute these variables in the formula, what we get is 64 into 1 plus 0.12 divided by 1 plus 0.07, and what you get by calculation is exactly 66.99. At the end you may write up a concluding line, that is fair forward rate for 1 year will be $1 equals to rupees 66.99. So it is fair forward rate and the period of the forward contract is 1 year. So its fair forward rate is $1 equals to rupees 66.99. Alright friends, let us move ahead and take up the next upcoming concept, that is concept number 12, arbitrage with forward contracts. And the moment you find this heading, the meaning of arbitrage in simplest words would be making riskless profit. That means making profit without taking any risk. And how it is done? It is done by buying something from one market and selling the same in another market. Once you write the meaning of arbitrage, that is making riskless profit, won't you be interested to know how to make that riskless profit? So the concept is straight and simple. You can make arbitrage gain by buying something from one market and selling the same in the other market. But to elaborately understand this concept, as in how does it apply with respect to forward exchange contracts in a forex market, let us understand everything in detail. So friends, what good thing you have learned by far is how to determine fair forward rate. You will even learn one thing about the theoretical concepts behind this, that is interest rate parity theory, purchasing power parity theory, Fisher's theory. All these theories will come at a little later stage in our discussion. You will then conclude that FFR, what you have just learned how to calculate, is basically an outcome of interest rate parity theory. So interest rate parity theory conveys how would you determine fair forward rate. Once you have computed fair forward rate, go and check with the bank what is the forward rate actually quoted by bank. So now we have two forward rates, one is the fair forward rate, another is the actual forward rate. If these two are same, we would say there is no opportunity to arbitrage. But if there is a mismatch between the two, especially a case where there is a significant difference between the two, you can say that there is an arbitrage opportunity. So you find a fair forward rate. If actual forward rate quoted by bank is greater than this, still you can make arbitrage gain. If it is less than this fair rate, still you can make arbitrage gain. Only a case where you cannot make an arbitrage gain is when bank is quoting the rate which matches with your fair forward rate. So friends, if I have to summarize the whole thing what I have just discussed, please pay attention on screen. We will write up some important conclusions and then we start attempting questions. So what we have just discussed is to determine whether arbitrage opportunity exists, first compute FFR and then compare the same with AFR. If AFR equals to FFR, there will be no arbitrage opportunity. Therefore, arbitrage opportunity arises only when there is a mismatch between AFR and FFR. What is the meaning of AFR and FFR? That also we have mentioned. FFR stands for fair forward rate and AFR stands for actual forward rate. Alright friends, let us move ahead and learn how to apply this concept, learn how to make arbitrage gain. So let us take up an important question, that is question number 21. Let us read this question first. It mentions spot rate $1 equals to rupees 64, interest rate prevailing in India as 12%, interest rate prevailing in the US is 7%. Now, fair forward rate is already given to you in the question as $1 equals to rupees 66.99. Friends, I am sure you will recollect this information we have faced just some time back in question number 18, correct? If question number 18 conveyed this information, this was the outcome that you have arrived at. This was the fair forward rate that you have computed in question number 18. This was in fact the answer to question number 18. Now let us see, is this an extension to that? Yes, because further actual forward rate is given to you now as 65.90 and question is asking you, does an arbitrage opportunity exist? If yes, then explain the arbitrage strategy and determine the possible arbitrage gain. So before we start solving the question, let us first understand the entire information given. So we have enough information for computing FFR. You can directly compute FFR. Spot rate was 64. The interest rate prevailing in India is 12% and interest rate prevailing in the US is 7%. So what you can simply do is 64 into 1.12 divided by 1.07 and you will get 66.99, and that is what we are calling as fair forward rate. But this was already computed and given to you. Now, the actual forward rate is rupees 65.90. On comparison, we find that definitely there is a mismatch between the actual forward rate and the fair forward rate. Whenever there is a mismatch, we definitely can create an arbitrage strategy. That means an arbitrage is possible. So an arbitrage opportunity definitely exists. This is the idea. But how would you make that arbitrage? This depends on identifying the right strategy. Now friends, please pay attention to how would you create an arbitrage strategy. You would observe that AFR is less than FFR, correct? FFR was 66.99 and AFR is just rupees 65.90. So we find that actual forward rate is lesser than what it should be. In other words, actual forward rate AFR is less than FFR. That means in the forward market, the price of dollar should be 66.99, but in the forward market, the price of dollar actually is 65.90. So that clearly conveys the message that in the forward market, the dollar is underpriced. Understand this point. In the forward market, dollar is underpriced. Why? Because its price should have been, I repeat, its price should have been 66.99. Its actual price is 65.90. It is underpriced. The moment I say dollar is underpriced in the forward market, what would you do if anything is underpriced? You would want to buy. So you should buy dollars in the forward market. So buying dollars in the forward market is your first part of the strategy. So you have planned to buy dollars in the forward market. But meaning of arbitrage conveys that buying something from one market and selling the same in the other market. That means if you want to complete the chain of arbitrage, you have agreed to buy dollars at forward market, you must sell dollars in some other market. Which other market do we have other than the forward market? The obvious answer is spot market. So I would say in the forward market, if you have planned to buy dollars, in the spot market you should plan to sell dollars. The arbitrage strategy that you formulate should be sell spot and buy forward. So friends, what I am trying to do is, whatever we have discussed by far, let us write up that much. Then I will take you ahead with how to plan the entire process of arbitrage and what kind of problems you are going to confront. Moreover, the strategy that we have just discussed, that is sell spot and buy forward, that strategy might need a supportive strategy along with it. So let us discuss all those matters little ahead, and what we have just discussed right now, I am showing the same on screen. Please note it down. So in the solution, you may write an arbitrage opportunity definitely exists as there is a mismatch between FFR and AFR. AFR is less than FFR. Therefore, the dollar is underpriced in the forward market. Therefore, it is advisable to buy dollars in the forward market. To take a counter position, one has to sell dollar in the spot market. So arbitrage strategy will be sell spot and buy forward. Alright friends, let us move ahead and discuss something very important. Arbitrage strategy you have already written. So sell spot and buy forward is your strategy. Now this strategy is going to come up with some problems. What are the problems that you are going to face? Let me explain. First thing, you are talking about sell spot. That means you have to sell dollars in the spot market. So to sell dollars in the spot market, from where would you get dollars? This is the first point. Second thing, once you sell dollars and get rupees in hand, what would you do with those rupees obtained? So problem number one is how to arrange dollars for selling the dollars on spot. And secondly, once you sell dollars and get rupee in exchange, what would you do with rupee obtained? So now the point is very clear. How are we going to tackle these two problems? So your first problem is you want to sell dollars in the spot. From where will you get it? Now the answer to that question is simple. You want to sell something that you don't have. Obviously, you will not buy and sell, correct? You cannot buy now and sell now, because buying at spot is not your objective, and doing that will be a madness. Buying spot and selling at spot is not going to work. You have to, if you are selling in the spot market, you are going to buy in the forward market. That is what your strategy says. That means you cannot buy it in the spot market. In the spot, you have to make a sale. So the idea is very clear. You want to sell something and you don't have it now, borrow it. That means you are going to raise borrowings in dollars to sell those dollars in the spot market. The second problem is, once I sell dollars in the spot market, in exchange I would be getting rupees. What would I do with those rupees obtained? Obviously, it's money in your hand, invest it. That means you have to raise borrowings in dollars, then sell spot, and finally what you do is you invest the obtained amount of rupee in India. That means your borrowings will be raised in US, your investment will be made in India. So here comes a complementary or support strategy to the primary strategy what we have designed. The primary strategy was sell spot and buy forward. The support strategy or complementary strategy would be borrow in USA and invest in India. So this strategy, borrow in USA and invest in India, is needful to make up this main strategy. So friends, what I am trying to tell you is, whatever you find on screen are problems. I am going to show you how to answer those problems, how to solve those problems. This, what you find on screen, need not be written in examination, but the background understanding of this whole matter, which I am showing on the screen right now, I want you people to write it down for your understanding without fail, and then we go with the arbitrage process. So just do one thing, whatever I am showing on screen, first note it down. So the solutions to these problems, we would write how to arrange dollars for sell spot. The answer is to arrange dollars, borrow in US dollar. What to do with rupee obtained? Invest such amount in Indian rupee. That means invest that amount in India. So you are going to raise borrowings in US and you are going to make investment in India. So the strategy that will support the main strategy will be called as complementary strategy, that is borrow in USA and invest in India. So borrowing in USA and invest in India, this becomes your support strategy to this main strategy, that was sell spot and buy forward. Alright friends, let us proceed ahead and plan the entire arbitrage process. So the strategy that we have just formulated, arbitrage strategy is sell spot, buy forward. The resulting complementary strategy is borrow in USA and invest in India. Let us do one thing now. These four actions, sell spot, buy forward, borrow in USA, invest in India, these four action plans, let us try to make them in a proper order. For example, you are planning to sell spot US dollar. To sell spot US dollar, first you should have US dollar, and that will happen only when you borrow in USA. That means you raise borrowings in USA. In other words, yet you would raise borrowings in US dollars. Then only such borrowed dollars can be sold. Correct? So what we do is, the core steps in your arbitrage process will be, first step as borrow in USA, second step will be to sell spot. Then once you sell spot, you will obtain rupees in exchange of dollars. So the obtained rupees will be invested in India. So step 3 will be invest in India. And finally, to apply your main arbitrage process, where you have planned to enter into a forward contract to buy US dollars, so you have that as your fourth step, that is buy forward. So friends, these four steps, what we have just written over here, these are the summary, or I would say core steps. Don't write up this, we are going to write this whole thing in details. What I have just tried to do is, we have changed the order of this whole strategy formulation into a proper step-by-step procedure. Let us move ahead and write up the process in detail. So the arbitrage process begins this way. Step 1, borrow $1 lakh in US at 7% per annum for 1 year. If at all you are wondering that from where did this $1 lakh come from, don't worry. It is just an amount that we have assumed to initiate the process. In examination, generally this amount with which you should take the start will be given. Only when it is not given, then you should take a proper amount. Generally a foreign currency amount of 1 lakh unit of foreign currency or 10,000 units of foreign currency would be the best. Now, when you have borrowed 1 lakh US dollar at 7% for 1 year, always remember that your obligation will be to pay back after 1 year $1 lakh of principal and $7,000 of interest. That means your obligation to pay back after 1 year would be $1 lakh 7,000. Step 2 will be sell $1 lakh, whatever you have borrowed, sell that $1 lakh at spot rate of $1 equals to 64. The moment you do this, you will be obtaining $1 lakh multiplied by rupees 64 per dollar. That is, you will be obtaining rupees 64 lakhs. So in the third step, what you will do is invest that rupees 64 lakh at 12% per annum for 1 year. Now don't forget, fourth step is the most critical step. Now you have agreed to borrow $1 lakh at 7% for 1 year. So after 1 year, you have to pay back $1 lakh 7,000. To secure that, you enter into a forward contract to buy dollars. So we write in short, buy forward $1,07,000 for a 1 year period. So that means after 1 year you have agreed to buy $1,07,000 at the contracted forward rate of rupees 65.90 per dollar. So you understood why we are buying forward 1,07,000 US dollars. So whenever you are writing this step, you should always give an elaborate explanation about this step. That will be enter into a forward contract to buy $1,07,000 after 1 year at contracted forward rate of $1 equals to rupees 65.90, and doing so your resulting obligation will be rupees 70,51,300, that is nothing but $1,07,000 multiplied by rupees 65.90 per dollar. Let us now move ahead in the process. What we will do, all the transactions that we have opened up, we are going to close all these. What I am trying to tell you is, you have already raised a borrowing, so now it's the time to repay after 1 year. You have invested rupees 64 lakh, it's time to encash the proceeds of your investment. So all the other steps would come up not at this point of time, it will be after the waiting period of 1 year is over. And obviously what we will do, we will plan the procedure ahead where we will first get this inflow. So the amount that you have invested will be matured and you will be getting the proceeds of this investment in hand. That will be utilized to honor this forward contract to get $1,07,000, through which you will be paying off your US dollar borrowings with interest. So let us see how to write up the process ahead. After 1 year, step 5 will be realize investments, that is rupees 64 lakh plus 12%, which will give you rupees 71,68,000. Honor your forward contract by paying rupees 70,51,300, and through which you will be obtaining $1,07,000. Through this obtained dollar amount, what you are going to do is repay your US dollar loan. And finally, you look into one thing, we have kind of closed all the transactions over here. So we have first realized this much rupee value of investment, and to honor the forward contract, the amount that we had to pay was 70,51,300. So do you notice one thing? There is a difference, substantial difference between this inflow and this outflow. So at the end, we would write up the result. Arbitrage gain will be inflow as per step 5 minus outflow as per step 6, and that will be rupees 1,16,700. So friends, please write up the remaining steps, and that will be end of the solution.